Now, as we turn to Asia, some of the things, and the reason why I'm just going to talk about South Korea for a moment. So North Korea has been launching more missiles into and testing. One of them came fairly close to Japan, which caused a bit of a panic when they set off alarms, sent people into bomb shelters to protect against a potential missile strike. It went over Japan, landed on the other side. But again, you're seeing how precarious things are getting. 12 North Korean, I think they were bombers, and they were fighter jets practicing surface-to-air combat. But there's a zone, not the de-escalation zone, but there's essentially a zone that has been approved that you don't go past. And North Korea went over it, which then caused South Korea to scramble 30 jets to potentially intercept. So there's, again, the geopolitical friction is rising. One of our new aircraft carrier fleet groups is now in the region, which it had entered South Korean EEZ space, and that was considered part of the impetus for what happened. There's some rumblings about potentially China moving some equipment into position against Taiwan. Again, a lot of this that is hearsay in terms of where it is. It's just something to keep on the back burner. But North Korea and Taiwan continue to see that ratcheting higher. But the bigger concern is going to be with Russia and the difficulties they're having in Ukraine, and how is that going to pivot some of the geopolitical moves. When you look at Russia, and then you look at China, you look at Russia, and you look at India, it's like, well, do you want the West or do you want Russia? And then you look at the OPEC moves, and you can take away everything that has been discussed from the geopolitical side. But when you just look at OPEC, and again, what they did is going to be supportive of pricing. That's going to be a problem for a lot of these emerging markets. And what are they willing to go up against, given the fact that they're going to see more pain? And again, there's a lot that comes on the back end of it, but you can try to boil it down to, well, they're going to get hurt with inflation. They're going to get hit harder, and their economies are going to be worse. And realistically, you're going to see the global economy move into that recession. So just looking at South Korea, which is a net exporting nation, trade balance again came in at higher at 3.7 billion. When you look at exports year over year, was expected to be up 3.3%, came in at 2.8%. Imports were expected to be at 17%, came in at 18.6%. So slightly better on the import side. Exports are continuing to struggle, and we're actually seeing a buildup in inventories, as we talked about last week on the tech side, which is a problem because typically imports are predictive of where exports are going to be. But there's some of that breakdown now because you're not seeing the intermediate goods move, and you're seeing some of that pressure, which is also being shown in the Korean manufacturing PMI, which came in at 47.3, which was was below last month of 47.6. It's moving in the wrong direction, while CPI continues to remain at 5.6%, with core moving slightly higher to 4.5%. And foreign reserves are shrinking. They were initially 436 billion, now they're 416 billion. And this is what we've been talking about with countries dwindling, backdrop, and where that protection is going to be. So now when you look at China's population and in turn to China's demographic crisis looms as Xi comes in with the birth rate has been declining for years, which we've talked about. But now the number of babies born each year fell by over 45%, and the population is expected to fall by over 800 million in 2100. So again, it's hard to extrapolate. There's a lot of things that can happen, but there is a big problem when you look at that population shift and what does that mean for Chinese GDP growth? What does that mean for their underlying ability to really maintain their cost center and to drive from the second largest economy to the first? they have a big demographic problem, which is, again, showing up in a lot of areas. But this is, I think, the biggest thing that is talked about, but maybe not understood when you look at how is China going to, again, leapfrog over the U.S., given some of the underlying issues that continue to crop up, not only on this, but also on the economic side. So Chinese residential construction investment year on year, well below 10% and moving to the lows that we saw during the COVID slump in 2020. And we don't see this changing, because if you think about the fact that the construction is still down year over year, you also have to consider how much stimulus was pushed into this specific sector. How many banks were told to invest in this specific area, and they can't get anything moving. And that's the biggest problem when you look at, you have a bank, so a bank lends money, so it lends money, and based on, they typically take assets as collateral, and then they'll issue something above that asset level. But again, you'll have some sort of component. Now you've had the banks that have a leverage ratio of 30 to 40 times, so much higher than Lehman when it broke down. But you also now have the asset side getting pulled down, because the mark to markets on those assets are getting worse. So technically the leverage ratio is getting worse because there's less assets as collateral. It's worth less. There's more bad debt. And now the government is asking banks to lend more at lower rates. So again, you're in this precarious situation that isn't going to end well when you look at the Chinese backdrop. Now, aggregate social financing, total in general, you can see is at negative 12%. When you look at corporate bonds, again, it's accelerating to the downside, while shadow financing is picking up. And that's the biggest component when you look at it, when you look at the shadow financing side, because the Chinese government has gone aggressively trying to cut that down, but that's starting to pick back up as banks, even though they've been mandated, they don't want to, and they're not looking to. And that is, I think, a bigger issue when you look at some of the problems coming up, especially when you look at the property market. Now, this is an interesting connection between China and Japan. So when you look at Japan over that period, you could see that Japan really tapped out about 1996, and then you had the Asian currency crisis of 98, and then QE infinity was kicked off by the BOJ starting that year. And then look at how Japanese housing starts really started to drop off, and it became a huge drag on the economy. So now look at China, which has similar to Japan, has a population problem, has an economic problem, has a debt problem, has an export problem, and has a currency problem. That's a lot of things to overcome to continue with some growth, unless you allow a more natural decline and a movement lower in that underlying market. So then when you look at China manufacturing PMI, expected to be at 49.7, came in at 50.1. So again, just kind of bumping along, but new orders, 49.8, negative contraction, but again, very ever so slightly. So not a huge drop, but still showing that sluggishness. But then when you look at Caixin, so it was expected at 49.5, came in at 48.1. New orders is at 47.1. So more of a concern when you look at this data set versus the other official data set. And it's a matter of balancing the two of which one not only just matters the most, but it's probably a mixture somewhere in between in terms of what the data is actually saying. We think it's a bit worse based on what we're seeing from ships and movements, but there's a lot to be followed on from that perspective. Now, when you look at new export orders, 45.5, but look at employment. Employment is something that both the official and the Caixin agree on. It's contracting, and it's been contracting. If you go back through 2016 onward, there's very few points in time when this has been in expansion. So the employment side is dwindling, which is a problem when you look at, well, what's happening with prices? What is happening with the consumer? Because China wants the consumer to be more aggressive, but they can't if their jobs are in question, and they have to rely more on the international market. But now new export orders are going down, and this is when you look at what has been happening that throughout most of 2020, they've been negative, and now you're coming into the winter season, the holiday season, and you're down again, and this is the problem that we're seeing on the Chinese data that is showing something, especially when you look at future output. Future output, 53.4. All of this is coming down. Now, input prices is showing a negative number, so we're in contraction, which is deflationary, and which is a positive, but how much of that is going to be passed on, and does it showing that there is a much bigger economic disaster, essentially, if you think about what a recession would look like, afoot, which is going to want to be addressed, or at least pushed back till after Xi is able to make it in for a third term. China non-manufacturing PMI was expected at 52.4, came in at 50.6. Output prices came in at 46.7. So the service side is slowing as people came out of some of the lockdowns. They caught up, and now, again, we see this trending down. We do see service, non-manufacturing, being slightly better than manufacturing, as we've been very consistent in saying. And that's something that we think is going to continue to be the case. But when that service is real, now non-manufacturing really rolls over, that's when we think that you kind of get that next leg down and additional pressure to the downside on the Chinese front. With the China non-manufacturing PMI new orders, was slightly contracting. Now it's at 43.1. Like, you are a deep contraction. And that's, I think, the bigger problem when you look at these leading indicators and just the global market. Global trade is slowing. All of these key pieces are slowing. And we're seeing that in segment one. We talked about the intermediate piece, which was contracting. That a lot of that goes through China. We've looked at some of these different entities, which is showing those pressure points, which are getting much worse. Global Taiwan manufacturing PMI, as you can see as well, coming in negative, close to 42, while Japan inflation continues to get worse. So again, it's not just China. We're not just picking on China. It's large parts of Asia are struggling. Now, some economics in terms of the ASEAN are okay, but some of these big behemoths on the tech side are getting worse, and not just slightly, but acceleratingly getting worse as inflation picks up in Japan, which is a bigger issue in general. Now, when you look at core inflation, yes, in Japan, it's still well below the G10 average of about 5%, but Japan shouldn't have inflation given what they, based on MMT and based on what they've tried to do, and they've been doing QE the longest. They're losing control on that. And then when you look at South Korea at 4.5%, there's still more of that upside. So not only do you have global trade slowing, the tech side slowing, the local economy slowing, their consumers slowing, but now you have that inflationary bite, which again, we see as that underlying problem that is not going away anytime soon, creating more and more problems for the Asian markets as the global markets continue to slow. So that's what we have for you today. If you have any questions, you can find us in the comments section. Obviously, I try to be as active as I can on Twitter, and we hope you have a great day. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.